If I told you there was a 70% chance your house would burn down, would you have homeowners insurance?
Of course you would. It's a no-brainer.
Right. You would probably have the most comprehensive, ironclad policy you could possibly afford. So why do 7 out of 10 people who are over the age of 65 people who will statistically need long-term care have absolutely zero plan to pay for it?
It is honestly the ultimate cognitive dissonance in retirement planning. We insure our cars against a minor fender bender, but we leave the most statistically likely major financial event of our later years completely unprotected.
Exactly. Welcome to the deep dive. Today we are looking directly at you and the massive hidden hole that might be sitting right in the middle of your retirement plan. We've got a stack of research and internal guides here from the Gruene Insurance Group, and they expose this gap that nobody seems to want to talk about.
It really is the elephant in the room.
Yeah. Our mission today is to figure out why we are so blind to this, and more importantly, how to fix it before it's too late. Okay, let's unpack this because honestly, the numbers we are looking at are terrifying.
They can be, yes, but let's set the tone right out of the gate here. This deep dive is absolutely not about fear-mongering. The goal here is empowerment.
I like that.
It is about taking a potential financial and emotional catastrophe and turning it into a managed, dignified plan. When you understand the landscape of long-term care, you remove the panic. You replace the unknown with a strategy.
I love that. To fix the problem, we first have to understand what the problem actually is. And I think a lot of people, myself included, before reading through this material, have a very skewed idea of what long-term care really means. Like we just picture a sterile nursing home facility.
Right, and that is the very first myth we need to dismantle. Long-term care is not simply a place you go when you are old. In the medical and insurance fields, long-term care is defined by your need for assistance with activities of daily living.
Okay, wait, let's pause there. Activities of daily living. We are talking about bathing, dressing, eating, toileting, transferring physically getting out of a bed or a chair incontinence.
Exactly.
This isn't about getting a specialized medical treatment or a surgery. This is just existing.
It is about a stage of life where your body, or your mind in the case of cognitive decline like Alzheimer's, can no longer do the foundational basics of daily life on its own. It's not about a medical cure. It's about maintaining your dignity and safety.
Wow.
And to your point about the nursing home stereotype, the data completely shatters that. A massive 73% of all long-term care claims start with home-based care. Only 9% begin in a nursing home.
73% at home.
Yes.
So the vast majority of the time, this isn't about being packed up and sent away. It's about bringing a home health aide into your own living room so you can stay where you're comfortable.
Precisely. But, and this is the catch, keeping you in your own home still costs an incredible amount of money.
Right. Let's talk about the real numbers, because this is where the house fire analogy really hits home. The 2024 costs are just chilling.
They are substantial. Currently, home care having an aide come to your house averages about $51,000 a year.
$51,000 just to stay in your own house.
Yeah. And if you need to move to an assisted living facility, the national average is around $66,000 a year.
And if you do end up needing that 24-hour skilled nursing care, a semi-private room in a nursing home is over $112,000 a year. That's over $9,300 every single month. How does a room cost more than a luxury hotel?
Well, because you aren't just paying for the real estate. You are paying for the sheer logistical intensity of round-the-clock custodial care. You are funding 3 shifts of nurses, certified nursing assistants, specialized dietary staff, physical therapists, and immense liability insurance.
That makes sense.
Healthcare is incredibly labor-intensive. And because of medical staffing shortages and inflation, those costs are accelerating much faster than standard consumer goods. With a 2.5% inflation rate, that $112,000 nursing home cost is projected to hit $186,000 a year in 20 years.
That is staggering. Trying to self-fund this is like trying to secretly buy a second house without telling your spouse, on top of funding your regular retirement, your groceries, your healthcare, your property taxes.
What's fascinating here is how the total lifetime cost breaks down and how unpredictable it can be for any single individual. According to the 2025 Milliman Long-Term Care Index, the average lifetime cost of care for a 65-year-old today is $135,000.
Okay, that's a lot, but maybe manageable for some.
But here is the critical part. That is just an average. About 15% of people will need care for 5 or more years. For that group, The average cost skyrockets to over $665,000.
Wait, over $500,000? How can anyone look at a potential $665,000 bill and just shrug?
They aren't shrugging because they have a $500,000 sitting in a checking account. They are shrugging because they're operating under a profoundly dangerous assumption. They think someone else is going to pick up the tab.
The government.
Specifically the government, yes.
This brings us to a statistic that blew my mind. 58% of Americans wrongly plan to rely on Medicare for their long-term care.
Over half.
Yeah. More than half the country is walking around thinking, I've paid into Medicare my whole life, so when I need help bathing and eating, they've got me covered.
It is the single biggest delusion in retirement planning, and we need to be incredibly clear about this. Medicare does not cover long-term custodial care. Full stop.
Wow.
To understand why, you have to understand the fundamental mechanism of how Medicare operates. It is designed for acute care, not custodial care.
Okay, acute versus custodial. So if I fall and break my hip.
That is an acute event. Medicare pays for the hospital stay, the surgery, the doctors. If you need a short-term stay in a skilled nursing facility to rehabilitate that hip, Medicare will cover up to 100 days, though you start paying co-pays after day 20.
Got it.
The defining characteristic here is that you got sick or injured, you are getting treated, and the medical expectation is that you will get better and go home.
But if my hip heals, yet my Parkinson's has advanced to the point where I can no longer dress myself or prepare meals.
Then you have crossed the line into custodial care. There is no expectation of getting better from a chronic decline. Because there is no medical cure being administered, Medicare's role ends entirely. They will cover exactly 0 days of ongoing custodial care. $0.
Okay, so if Medicare only covers getting me back on my feet, what happens when people realize they are entirely on their own for the daily maintenance of their life? They scramble, right?
Absolutely.
They start trying to patch the hole with Social Security. But here's where it gets really interesting. I did the math on this while reading the guides. The maximum Social Security benefit is around $3,600 a month.
Right.
But you just said a nursing home is over $9,300 a month. The math fails completely. It's a gaping hole of almost $6,000 a month.
The math fails catastrophically. And when that realization hits, people assume there must be some sort of ultimate government safety net. And there is. It's called Medicaid.
But Medicaid is different, right?
Medicaid is fundamentally different from Medicare. Medicaid is a joint federal and state program designed exclusively for people with very low income and limited resources.
So to get Medicaid to pay for your long-term care, you have to go through an asset spend down. Can you explain the actual mechanics of that? Because it sounds like financial ruin by design.
It essentially is. To qualify for Medicaid, you cannot have significant assets. You effectively have to impoverish yourself.
Impoverish yourself. Jeez.
Yeah. If you have a joint savings account with your spouse, investments, a second car, you have to spend almost all of that money on your care out of pocket first. The state looks at your finances and says, you have $200,000 in savings. Go spend that on your nursing home, and when you're down to your last $2,000 or $3,000, then we will step in.
Wait, what about the healthy spouse? If one person gets Alzheimer's, does the healthy spouse just lose their entire retirement nest egg to the spend down?
There are spousal impoverishment laws that allow the healthy spouse to keep a certain portion of the assets, like the primary home, and a fraction of the savings. But it is heavily capped. The healthy spouse is almost always left living on a significantly reduced fraction of what they had planned for their retirement.
That's awful.
The Gruene Insurance Group guide phrases this perfectly. They say, Medicaid is not a retirement plan. It is a financial catastrophe with a government safety net at the very bottom.
So if people can't rely on the government and they realize Medicaid will bankrupt their spouse, what's next? Usually it's denial.
Oh, the denial is strong.
The mental gymnastics we do to avoid this topic are wild. People just say, well, I simply won't need it. I eat kale and jog.
Which directly contradicts the foundational reality we opened with. 70% of people over 65 will need some form of long-term care. You cannot look at a 70% probability of a major event and build a financial plan on the assumption that you'll simply be in the lucky 30%.
Right. You just can't.
Strokes, accidents, and early onset dementia do not wait politely for what we consider old age. They happen unpredictably.
And when the denial fades, people pivot to the most emotionally loaded excuse of all. They say, my family will care for me, my kids will step up.
That is a tough one.
It is. But there is a truly tragic reality to that assumption. 63% of family caregivers end up draining their own retirement savings to provide or fund care for their loved ones.
The physical and financial toll on family caregivers is immense.
Hmm.
We are talking about the sandwich generation adults who are trying to save for their own retirement, raise their own children, and suddenly they're hit with a $4,000 a month bill for a parent's home health aid.
Yeah.
Or worse, they have to quit their jobs entirely to provide the physical care themselves.
Because long-term care facilities are full of people whose families deeply loved them and intended to care for them, but just physically or geographically couldn't, you try safely lifting a 180-pound adult out of a slippery bathtub when you have a bad back yourself.
You really can't.
You can't provide 24-hour dementia care and hold down a full-time job. It breaks people.
If we connect this to the bigger picture, a lack of long-term care planning doesn't just ruin your retirement. It fundamentally threatens your children's financial future and their own health.
So if the government won't save you and you don't want to bankrupt your kids, why do people still wait? Why not just buy the insurance tomorrow? The excuse is always, well, I'll just get coverage later when I'm older and closer to actually needing it.
That stems from a fundamental misunderstanding of how insurance works. Insurance relies on a risk pool. You need a large group of healthy people paying premiums to support the few who get sick at any given time.
Right. That's like trying to buy auto insurance after you've wrapped your car around a telephone pole.
Exactly. If you wait until the house is already smoking to buy fire insurance, the company cannot put you in the healthy pool. You are a guaranteed loss.
So the underwriting door slams shut.
Completely. You can only buy the umbrella before it starts raining. If you wait until your late 60s or 70s, or wait until you have a cognitive decline diagnosis or a major health scare, two things happen. Either the premiums will be astronomically high because your risk profile has spiked, or the insurance company will simply decline you entirely. You lose the chance to qualify.
Okay, so we've established the massive risk. We've eliminated the false safety nets of Medicare and Medicaid. We've stripped away the excuses about family handling it or buying it later. Now, let's get to the actual solutions. How do we fix this hole?
The industry has evolved significantly from the rigid policies our grandparents might have had. There are primarily three avenues to consider today.
Okay, let's hear them.
First is traditional long-term care insurance. This is a standalone policy. You pay a premium, and if you need care, it pays a daily or monthly benefit up to a lifetime limit. The advantage is that it usually offers the maximum amount of long-term care coverage for the lowest initial cost.
But the downside of traditional policies is that they are use it or lose it, right? Like if I die peacefully in my sleep at 90 without ever needing help, I don't get a dime of those premiums back.
Correct.
And historically, the premiums on traditional policies have sometimes spiked unexpectedly over time.
Yes, and that is a major psychological hurdle for consumers, which is exactly why the market introduced the second option. And it is increasingly popular: hybrid life and long-term care policies. These are essentially life insurance policies with robust long-term care benefits built directly into them.
Wait, hold on. A policy that guarantees to pay out for my care if I get sick. A&D guarantees to pay a death benefit to my family if I don't.
Exactly.
How does an insurance company offer that without going broke? What is the catch?
It is not a trick. It is a calculated bet on the time value of money. When you buy a hybrid policy, you are typically locking it in earlier in life. The insurance company invests those premiums for decades. They are earning returns on your money while you are healthy.
Oh, I see.
In exchange for them holding that money, they guarantee that your premiums will never increase. And it completely eliminates the use it or lose it fear. If you need long-term care, the policy pays out to cover your home health aid or your assisted living. If you never need care, the policy pays a tax-free life insurance death benefit to your family. Either way, value is returned.
That makes a lot of sense. And the third option is a life insurance policy with a long-term care rider. This sounds similar, but how is it different?
With the rider, the primary goal is usually leaving a legacy or a large death benefit for your heirs. The long-term care rider simply allows you to accelerate a portion of that death benefit to pay for care if you happen to need it.
Let's break down accelerating a death benefit, because that sounds like industry jargon.
Fair enough. Think of it as a cash advance. You are tapping into your own life insurance payout while you are still alive to pay for your nurses or your facility. Whatever money you don't use for care is then passed on to your kids when you pass away. Across all these qualified plans, the benefits you receive to pay for care are generally tax-free.
To really drive home how these policies operate in the real world, the internal guide includes this incredible tale of two couples scenario. I want to walk through this because it crystallizes the true impact of this planning.
It is a sobering comparison. Picture two couples. Both are in their early 60s. Both have been responsible throughout their lives. They have healthy habits. They've saved diligently for retirement.
Right.
But neither of them had gotten around to buying long-term care insurance.
Now, at age 68, one spouse in each couple suffers a severe stroke. What happens to couple one?
So let's look at couple one. They have no coverage. After the hospital rehab, the healthy spouse tries to provide the care at home, but the physical demands, the transferring from bed to wheelchair, the bathing, become too intense.
Yeah, that's just too much for one person.
So they hire a home health aide, paying entirely out of pocket. That is $4,000 a month. Eventually, the care needs escalate, and they have to move the spouse into an assisted living facility at $5,500 a month.
The numbers add up incredibly fast. I mean, within 3 years, $270,000 of their hard-earned retirement savings is completely gone. Poof! And the healthy spouse. They are physically exhausted from the caregiving they did manage to do, and now they're financially terrified because the nest egg they were relying on to live out their own remaining decades is decimated.
Compare that to couple two. They face the exact same health scenario, the exact same stroke at age 68. But this couple sat down at age 54 and purchased a hybrid long-term care policy.
Oh, wow. So when the stroke happens, their benefits kick in immediately.
Yes. The cost of the home health aid, fully covered by the policy. When the transition to assisted living becomes necessary, also fully covered, their retirement savings stay completely intact.
That's incredible.
They continue to generate the income they planned for. The healthy spouse can focus on being a loving partner, spending quality time with their spouse, rather than being a burnt-out, overwhelmed caregiver. And the adult children do not have to step in and choose between funding their own kids' college or paying for their parents' care.
So, what does this all mean? It means that one single financial decision made in a relatively calm moment years prior fundamentally changed the entire trajectory of a family's life. It protected the healthy spouse, it protected the legacy, and it preserved everyone's dignity. So, if we know all of this, what do we do today? What is the blueprint?
The materials provide a very clear three-step action plan for listeners, and it starts before you ever spend a dime.
Step 1. Have the conversation today. Look, this is not a fun topic to bring up over a Tuesday dinner, but you have to talk with your spouse and you have to talk with your family. Ask the uncomfortable questions.
Right.
If I had a stroke tomorrow, who would physically care for me? Where would the money come from to pay for an aide? What would happen to our joint savings?
And you do not need to have the answers to those questions today. The goal of step 1 is simply to break the ice. Acknowledge that the risk is real and that ignoring it is not a strategy. Just start the conversation.
Step 2. Don't wait until you think you're old enough. The absolute sweet spot, the best time to buy long-term care insurance is in your 50s.
That is when you are generally still healthy, which means you can pass the medical underwriting and your premiums are at their absolute lowest. Once you hit your 60s, the cost jumps significantly.
And if you wait until a diagnosis happens, like a tremor or a mild cognitive impairment, the window closes forever. Waiting costs you money, or it costs you the chance to get coverage entirely.
Exactly.
And step 3, call Gruene Insurance Group for a free consultation. What stood out in their materials isn't just the math, it's the strategy. They act as brokers across multiple carriers, which fundamentally changes how you buy insurance.
It does. Long-term care planning is complex and highly emotional. Gruene Insurance Group approaches it entirely through the lens of education first. It is a no-pressure consultation. Because they represent multiple top-tier carriers, they are not locked into selling you one specific company's product.
They actually shop the market for you. They pull quotes from multiple carriers, compare traditional versus hybrid options, explain the nuances of each policy type, and help you find something that actually fits your specific life and budget. They can even plan for spouses who might have very different needs or health profiles.
This raises an important question about who you trust with this process. I think the philosophy of the owner and founder, Dawn Levis, really sums up the approach. She says, with us, you're more than insured, you're family.
That's a great approach.
They have a wide footprint, too, serving families across Texas, Arizona, Florida, California, Oklahoma, and West Virginia. It's about having an objective, trusted partner when you are navigating one of the most significant financial decisions of your life.
Look, long-term care is the most predictable, major financial risk you are going to face in the second half of your life. Ignoring it will not make it go away. It won't stop the clock. Your future self and absolutely your children are depending on you to look at these numbers and make a plan. because hope is not a plan.
It certainly isn't. And as we close, I want to leave you with one final deeply provocative concept to mull over before you initiate that family conversation. We mentioned the Milliman Index statistics earlier, but there's a nuance hidden in that data that demands attention.
Oh.
The average lifetime long-term care cost for a man is $98,000. But for a woman, the average lifetime cost is $171,000.
Wow. Wait, almost double. Why is there such a massive gap?
Because statistically, women live longer. They need long-term care 75% longer than men on average. Often, a wife will care for her husband at home until he passes, depleting her own physical energy and a large portion of their joint savings.
Oh, I see where this is going.
But when she subsequently ages and needs care herself a decade later, she's living alone, the money is gone, and she has to pay for professional caregivers out of pocket. It begs a crucial question. Does the lack of formal long-term care planning in America fundamentally represent a hidden, catastrophic tax on women's longevity and their historical roles as default family caregivers?
Man, that is heavy, but it's so necessary to think about. That goes right back to the burning house analogy we started with. If you knew the fire was disproportionately going to affect the woman you love, you wouldn't hesitate for a single second to buy the policy. Stay curious, have those tough conversations today, and get protected.